Hello, and welcome to this episode of the Insights Interview, where we explore the evolving landscape of finance and technology. I'm Jack Robertson, data journalist at the Payments Association, and today we're diving into one of the most complex costs in payments, scheme fees and the gap they open up for acquirer profitability. Joining me is John Burns, Managing Director of SRM Europe. John, great to have you on the podcast. Welcome.
Yeah, thank you, Jack.
If we're to sort of start by setting the scene, with thin margins and rising complexity on the acquiring side of payments, why is profitability so hard for acquirers to control right now?
I think it's always been difficult. I mean, the acquiring side of the equation, which is the payment acceptance, really important. We all want to spend and we all want a seamless sort of, risk-free experience doing so. Acquirers have a lot to put up with. They are the last resort in terms of, if it's not fraud, it's going to be a chargeback. And so they've got a lot of costs built into that. They've got a lot of technology. There's a lot of moving gears. And they've got a merchant base that has got technology itself. They've got to integrate that. They've got to send the transactions through to the schemes. I guess scheme fees have been increasing, and we're going to talk more about that over the last decade, and margins have been under pressure. And I think it's a very, very tough environment. I mean, on the issuing side, you're probably talking percentage, 1 or 2 from maybe 3%. On the acquiring side, the margins are really slim, maybe 10 to 30 basis points. It's pretty tough environment for acquirers.
Yeah, absolutely. So you just touched on scheme fees there and how they've changed over the past years. So why are they still so much harder to track and recover than interchange?
Scheme fees are complicated, and there's a lot of them, and they're prone to change as well. And what happens in that environment is that I think the industry, the payment acceptance industry, like acquirers, the software vendors, no criticism, but they're slightly behind the curve in sorts of they're always playing catch up. So even though the schemes are quite noble and very professional in publishing, bulletins informing the industry, the acquirer is there having to sort of absorb that, make the business changes, make the code changes, do the testing, apply that, and then also try and provide that evidence, if you like, to the merchant when they invoice them for scheme fees. And that's a big problem. And it's not easy, and I call it, margin erosion. And if you talk to acquirers, there's often, the term is, we're leaving money on the table, which is a sort of euphemism for they're just under recovering scheme fees that they could have been passing on in the interchange plus environment. They're unable to do so because of technology and catching up on applying those new scheme fees.
Yeah, absolutely. So often even the schemes can't give acquirers the billing data they need to pass fees on accurately. So what's changed to make full recovery achievable now?
I think, again, let's be careful not to bash the schemes, because I think the schemes are working very, very hard. I mean, the PSR is looking into this. I mean, the PSR have published some data to say that scheme fees increased by 25% from, I think, 2017 to 2023. And there's a number of factors for that. There's been a lot of new products introduced by both the schemes, and therefore there are fees associated with that. So but what it means is, to the acquirer, you're accepting these different payment acceptance types or these different payment channels, and therefore you've got to apply these scheme fees, which comes back to my comment about it's complex, and you've got to get them into your IT department and into your billing engine and so on and so forth. But it's just difficult for acquirers to sort of like recover those in a transparent way. And another factor is that, in those enterprise environments where you've got, large digital players, as you can imagine, they're very well informed, and they're challenging acquirers to give them that information that they, desperately need. They're saying, look, scheme fees have increased. We all accept that. But I want the detail. I want the line item detail around those scheme fees. And acquirers struggle to give them that. And consequently, I mean, whilst the schemes are working with the industry and doing a lot more, they're publishing fee guides, both Visa and MasterCard are active on that front. There's still not enough information at an electronic level in the clearing and settlement data that they send to acquirers. And that leaves a gap, and that's a gap that we've been working, quite, I think, effectively to fill.
Yeah, so we've spoken about that money that's left on the table. So how big is that profitability gap most acquirers are carrying without realizing? And I guess where does that leakage really tend to sit?
Most acquiring operations that I look at, they'll have a very effective, a profitability team, revenue team. They look at the monthly reports. So they'll get monthly reports from the schemes. And on those monthly reports, they're quite detailed. They'll give all of the information in terms of what fees have been applied and what they need to reimburse the schemes. And of course, they want to sort of look at that. If it's an interchange plus model, they're saying, I've collected the interchange. That's, on behalf of the issuer. I've collected the scheme fees on behalf of the schemes. And then I do a calculation, and there's often a delta, and that delta is negative. And that can be, I don't want to throw massive numbers around, but with slim margins, typically there could be somewhere between, medium-sized acquirer, a tier one acquirer, somewhere between 5 and 10 million may be under-recovered. That doesn't mean that acquirers don't recover it. It just means that you're trying to recover it after the event. And you can imagine with an enterprise merchant how difficult that is from a business development relationship point of view, going and saying, actually, we under-recovered. We're looking through the rear view mirror and we notice that we've got 3 months of under-recovered fees, or even worse, a year's worth of under-recovered fees. Well, often the acquirer might swallow that because it's too difficult a conversation to have and could result in regretted attrition. So what we've been doing is to try and bring that sort of scenario. So instead of looking through the rear view mirror, we've actually been working, quite closely with Visa actually to augment the information that they provide, the clearing and settlement services and data that they provide to acquirers. And we've been working with that to break it down to billing line, detailed information at, a cardholder acceptor ID and merchant ID. So we can give acquirers now that billing line, detailed information, which they can roll up or roll down as they wish. And we do the same for MasterCard as well. So the two major card schemes, we do that. And we found that acquirers have quite an appetite for investigating that.
Yeah, absolutely. So quite a big question here, but if I'm to ask you to put your future gazing hat on to 2027 and beyond, of course, regulators are obviously taking an active interest in scheme fees, and the schemes themselves are looking to bring greater transparency. So what changes does this really bring for acquirers and, of course, their merchants?
I think it's just that, acquirers again, look, I've got a lot of empathy with the payment acceptance side of the business, and I think that's where I've concentrated my efforts. It's a changing landscape. New payment types will emerge. Open banking, and not to plug open banking, but it's quite a little bit clunky at the moment from a consumer perspective. But I'm aware of innovations in that space that is going to sort of smooth that journey. I think that'll be a great challenge to the card payment environment. The card payment rails are robust, great. The payment system has been there for a long time. There's really good protection for all parties in that sort of ecosystem. I think it'll continue to flourish. I think wallets, I'm not going to sort of predict too much, but I think, if we just look at ourselves as consumers, if I leave my wallet at home, my physical wallet with the leather thing, I won't return home for it. But if I leave my phone at home, I'll walk back and get it because I'm absolutely lost without it. And it's mainly the payment side of the things that I really need that for. So I'll just go around and pay. I think wallet transactions will increase more. They're tokenized, they're safe. Both the schemes have been quite active in sort of bringing their, touch to pay products to market. So yeah, I think a lot will change in that space. Make the whole transaction environment more secure as well, which can't be a bad thing.
Fascinating discussion, John. Thanks for sharing your insights. Anything else you want to
add? Yeah, just one small thing, Jack. We've, if people who are interested in this subject matter, we've got a white paper that has been written, and that will be published on the SRM Payment Association website around September time.
And to our listeners, thank you for joining us on this episode of the Insights Interview. If you'd like to learn more about SRM and the topics that we've covered today, do visit their Members Hub page for an up-and-coming white paper in September.